The most boring investment strategy on earth has quietly created more millionaires than crypto, stock picking, and day trading combined. If you are new to investing in 2026, this is going to feel completely backwards because everything around you is telling you the opposite. You open your phone and see screenshots of accounts doubling. Someone turned $5,000 into $50,000. Someone found the next AI stock. Someone retired early because of crypto. And for a moment, you wonder if you are already behind. But here is what almost nobody posts. The account that is down 70%, the panic selling, the person who spent 3 years chasing the next big thing and ended up exactly where they started. Those stories do not go viral. So you are left believing that investing is supposed to be exciting, that the people getting rich are constantly making brilliant moves, buying at exactly the right time, selling at exactly the right time, always staying one step ahead. But that is not what creates wealth. The people quietly building real wealth are doing something completely different. They are doing something so boring. Most people ignore it, and that is exactly why it works. By the end of this video, you will understand why one simple investing strategy has quietly created more millionaires than almost anything else, why trying to beat the market usually backfires, and why waiting another year to start could become one of the most expensive financial decisions you ever make. Most beginners think investing is about picking winners, finding the next Apple, the next Nvidia, the next Bitcoin, the next company nobody knows about yet, because that is what gets attention. Nobody posts a screenshot of automatically buying the same index fund every month for 15 years. That is boring. Nobody goes viral because they consistently invested every paycheck. Nobody gets interviewed because they quietly ignored the headlines. But that is usually what real wealth looks like. It is repetitive. It is predictable. It is almost invisible. And that is exactly why people underestimate it. Instead of building a system, they spend years looking for a shortcut. They watch another video, read another article, download another app. Wait for a better time. Wait for the next recession. Wait until they make more money. Wait until they feel confident. And without realizing it, they have spent 5 years preparing to invest instead of investing. That is the real cost, not choosing the wrong stock. Waiting. Because every year you stay on the sidelines is another year your money never gets the chance to compound. Most people are afraid of losing money. Very few realize how much they lose by never getting started. Here is what separates the investors who build wealth from the ones who do not. Successful investors are not usually better at predicting the future. They are better at staying invested. That is it. Instead of trying to guess which company wins, they buy the market. One investment. Hundreds of companies. Some will fail. Some will dominate. Some will not even exist 20 years from now. But the market keeps adapting. You stop betting on one company. You start owning the economy. That is what an S&P 500 index fund is. You are not trying to beat American business. You are participating in it, and that mindset changes everything. Because now every paycheck becomes another opportunity to buy ownership, not another opportunity to gamble. Here is where things get interesting. Professional fund managers have research teams, analysts, expensive software, decades of experience. Their entire career depends on beating the market. And yet, most do not. People with more information than you, more resources than you, and more experience than you still struggle to outperform a simple index fund over long periods of time. So why are beginners putting pressure on themselves to pick winners? The goal is not to beat the market, the goal is to own it. That is a much easier game. And more importantly, it is a game you can win. Most people imagine investing as something complicated. Charts, indicators, constant decisions, watching financial news every day. But starting can be surprisingly simple. Open a brokerage account. Choose a low-cost S&P 500 index fund. Automate your investments. Then repeat that process every payday. No guessing, no chasing headlines, no trying to outsmart millions of other investors, just consistency. Because the biggest enemy of investing is not a market crash. It is emotion. People buy when they are excited, sell when they are scared, wait when they are uncertain. And those emotional decisions quietly cost them thousands of dollars over a lifetime. Automation removes emotion. And removing emotion removes one of the biggest obstacles to building wealth. But even if you understand index funds, even if you understand the S&P 500, there is another decision that quietly determines how much of your money you keep. And it has nothing to do with picking a better investment. It has everything to do with where you hold it. Because what you buy matters. Where you buy, it matters too. Most people spend all their time asking, what should I invest in? Very few ask, where should I invest? But over the next 30 or 40 years, that question could be worth tens or even hundreds of thousands of dollars. Imagine two people. They both invest the exact same amount. They both buy the exact same S&P 500 index fund. They both stay invested for 30 years. Same discipline, same returns, same consistency, but one of them ends up keeping significantly more of the money. Not because they were smarter, not because they picked a better investment, because they picked a better account. That is where a Roth IRA becomes so powerful. You contribute money that has already been taxed. But if you follow the rules, every dollar of growth can come out tax-free in retirement. Not tax-deferred, tax-free. And when you are investing for 30 or 40 years, that is a huge advantage. It allows compound interest to keep working without eventually giving part of those gains back. Simple decision, massive long-term impact. That is the theme you will notice over and over again. Building wealth is not usually about making one brilliant decision. It is about making dozens of simple decisions that quietly compound over time. If this is making sense, hit like right now. And if you are not subscribed yet, subscribe to the channel. New videos every week that build directly on what you are learning today. Here's the part that nobody prepares you for. Nothing exciting happens. You finally open the account, you buy your first index fund, you invest a couple $100, you feel good, you check it the next day. Nothing. Next week, almost nothing. A month later, still nothing that changes your life. You start wondering if everyone else knows something you do not. You see another crypto rally, another stock doubles, another headline about artificial intelligence creating overnight millionaires, and suddenly your boring strategy starts feeling boring. That is where people leave. Not because the strategy stopped working, because it stopped entertaining them. Take a look at this curve. The beginning is almost flat. Years of investing can feel like absolutely nothing is happening. Then something changes. The growth starts creating more growth. Your returns begin earning returns. And eventually the curve starts moving almost vertically. This is the moment everyone wants. The problem? Most people quit before they ever reach it, because compounding asks for something that is incredibly difficult: patience. The first 5 years do not look impressive. The next 10 years look better. The years after that are where things become extraordinary. But you only get there by surviving the boring years. That is why I think compound interest is misunderstood. People know the math. They do not understand the psychology. Before we keep going, quick question. What's actually stopping you from investing right now? Is it money, fear of losing it, or just not knowing where to start? Drop a comment below and let me know. I'm willing to bet most people watching fall into one of those three categories, because the answer to that question determines what you should focus on next. Social media tells you to fear missing the next big winner. I think that is completely backwards. The biggest thing you are missing is not a stock. It is time. Every year you wait is one less year your money has a chance to grow. Think about two friends. Both make $60,000 a year. Both eventually decide to invest. One starts today. The other waits 5 years because they want to learn more. Neither one is reckless. Neither one is making bad decisions. One just starts earlier. Fast forward 30 years. The difference is not usually intelligence. It is not effort. It is not talent. It is simply that one person gave time more opportunities to work. That is a kind of FOMO nobody talks about. Not missing the next Bitcoin. Missing the chance to let 30 years become 31. Then 32. Then 33. Because compound interest does not care whether you are motivated. It only cares how long you stay invested. There is another reason boring investing feels difficult. Nothing changes in your daily life. You still drive the same car. You still go to the same job. You still wake up and make coffee in the same kitchen. From the outside, it looks like nothing is happening. Meanwhile, someone else finances a luxury SUV, posts vacation photos, buys expensive watches, upgrades everything, and it feels like they are winning. But appearances and wealth are very different things. One person is buying assets, the other is buying proof. One is building freedom, the other is building an image. And that is a distinction that becomes incredibly important later. Because the people quietly building wealth often look like they are falling behind in the beginning, until one day they are not. Which leads to one final mistake that quietly destroys more wealth than bad investments ever could. It is not picking the wrong stock. It is not missing the perfect time to buy. It is something almost everyone does every time they get a raise. They spend it. A little more income turns into a slightly nicer apartment, a newer car, a bigger TV, more subscriptions, more dinners out, more things that slowly become normal. And none of those decisions feel expensive on their own. That is what makes lifestyle inflation so dangerous. It does not happen overnight. It happens one upgrade at a time, one monthly payment at a time, one "I deserve this" purchase at a time, until one day you are making twice as much money as you were 5 years ago, and somehow you are still living paycheck to paycheck. The people who quietly build wealth usually do not invest because they have extra money. They have extra money because they decided to invest first. Every raise becomes another opportunity, not to look richer, but to become richer. If your salary goes up by $5,000, nobody says you have to spend all $5,000. Maybe $1,000 improves your life today. The other $4,000 quietly improves your future. Those decisions do not feel exciting. Nobody congratulates you for increasing an automatic investment. Nobody notices that you kept your old car for another 2 years. Nobody sees the extra money going into your Roth IRA every month. But that is exactly the point. Real wealth is usually invisible while it is being built. And I think that is where investing becomes more about psychology than money. Because the people who look successful are not always the people building wealth. One person buys the luxury SUV. Another quietly increases their index fund contribution. One person posts vacation pictures. The other quietly maxes out a Roth IRA. One gets likes, the other gets compound interest. And compound interest does not care whether anyone notices. It keeps working anyway. That is one of the strangest parts of building wealth. For a long time, it looks like you are falling behind. You are driving an older car, skipping upgrades, passing on things your friends are buying. From the outside, it looks like you are doing worse. But you are playing a completely different game. You are buying freedom instead of appearances. You are buying options instead of status. And one day, those quiet decisions become impossible to ignore. That is the whole point. I think the biggest lesson here is not about index funds, or Roth IRAs, or the S&P 500. Wealth is built quietly. You do not wake up one morning and suddenly feel wealthy. You build a system, you automate it, you repeat it, and then you give it enough time to work. That is why boring investors keep winning. They are not smarter. They are not luckier. They simply stay invested while everyone else keeps starting over. If that finally clicked for you, subscribe to the channel if you are not already. Every video on this channel is built to help you make one smarter money decision at a time. This is where most people get it wrong. They start investing, but at the same time, they start trying to look successful. And that is exactly what keeps them stuck. In the next video, I break down why trying to look rich early on is one of the biggest financial mistakes you can make, how it quietly destroys wealth, and why some of the people who look the richest are often the furthest behind financially. I'll see you in the next one.